Until now, rock-bottom interest rates have helped home buyers move out, move up, essentially move on from renting. But now there's a new reality. Changes to mortgage rules took effect today, and what some Canadians have saved up to start owning may now not go far enough. The rules affect an industry that's a big part of Canada's economy. Last year, almost 10% of our gross domestic product, and growing amid declines in energy and oil. It also drives a lot of jobs, from agents and lawyers to construction, so a lot at stake. The CBC's Jacqueline Hansen has more on what this all means. Jacqueline?
Well, Diana, this targets people with small down payments who want to take on big mortgages. But underneath that, it's also about Canadians' addiction to cheap debt and the risk that poses to the entire economy.
So you've been living in this neighborhood.
Kevin Thorne and his wife had hoped to buy the condo they currently rent.
So I'm in that building right up there, corner unit.
Just last week, with a 5% down payment, they qualified for a $400,000 mortgage. This week, just $340,000, thanks to the tough new mortgage rules. Their condo now out of reach.
We may have been priced out of owning anything that's really in the city because, you know, not a lot of condos are going less than $400,000.
Borrowers with less than 20% for a down payment must now pass a stress test to insure their mortgages. Could they still handle a much higher rate set by the Bank of Canada, about 2% above current rates? This mortgage broker expects the rules to hit people with no equity the hardest, namely first-time buyers. Some will change their plans, others
are probably going to be borrowing additional money so that they can increase their down payment and qualify for the same amount of home that they wanted previously.
But for the federal government, that isn't the point.
What we're doing is really trying to ensure that Canadians take on a mortgage that's the right level of mortgage for themselves and their families, not presenting them with undue risk.
And not put the overall economy at risk.
It's a financial seatbelt. So the government is saying, yes, we're going to legislate seatbelts. We're going to make you protect yourself. So just in case interest rates do rise significantly, you'll still be okay.
But it could have other consequences. Demand could drop, and so could prices. That may be welcome in some of Canada's hot housing markets like Vancouver and Toronto. But in other markets like Calgary, where demand is already down, not so much.
There are concerns that first-time home buyers will head to the sidelines in markets will be sidelined by these mortgage regulations in those markets that are already facing challenges or don't need to be cooled.
In Toronto,
you know, it's essentially impossible now to look to own somewhere where you can start a family.
Instead of buying, Thorne's new plan is to move in with the in-laws and keep saving. Today's tougher stress test should limit new debt Canadians take on, but we're already sitting on about $2 trillion of it, most of that in mortgages. And Diana, until now at least, that number has just kept on climbing.
Thanks, Jacqueline. Jacqueline Hansen in Toronto.